Welcome back to the Legacy Wealth Coach channel, where we share our knowledge and collective experience on how to control your capital while building predictable monthly passive income streams. I'm your IBC and DIBS coach, Mike, joined here again today by with Pei, our queen of passive income stacking. In the last episode, we talked about where investors store their capital between deals and opportunities and why liquidity is such an important part of any investment strategy.
Yep. And that conversation leads to deeper questions. So that is why we're back today to answer these questions. So, Mike, what is your money actually doing and where should it go?
Right. Well, I mean, that's a big question, and obviously, my money is not in any one place. Typically, most people will have a variety of places where their money sits, right? For example, over the years, we've acquired properties and real estate, and we obviously make payments to, the mortgages. As you do so, you build up equity in each, property. So we have capital stored in the equity that we pay down in the real estate. We obviously have bank accounts, checking and savings accounts across, I think, 5 or 6 different banks. So there is money there, right? That is what most people are familiar with and use. I also have brokerage accounts and various investments, stocks and equities. So among those things that most people are familiar with, however, the vast majority of our capital resides in our system of IBC policies.
And it took us a while to get there, right? Because when we were W-2 workers and just starting out years ago, the focus was pretty simple. We make income, we earn income, trade time for money, we save, and then we maybe invest according to what the mass media tells us to do. But as we learned more and started digging and getting more involved in investing, then we started learning about different things, and we learned not to give up control of our money and let somebody else take over and do things that kind of we have no idea what's happening. But once we started transitioning into practicing IBC and then ultimately income stacking and doing DIBs, everything changed. How would you describe that shift from your perspective?
Yeah, I mean, you mentioned it, right? Like for the default scenario, right? We have our money sitting in a savings or a checking account at the bank. And that money to us, if you're just a typical consumer at the bank, it's sitting idly, right? Well, really it's not, right? Because what do they do when that deposit comes in? The banks as institutions, as bankers, they're smart. They're going to take your money and extend it out in various loans and, other amortized debt instruments that earn them multiples of whatever they're paying you for that meager interest. So understand your money's always going to be at play and in motion. It's just that, for most people, they're sitting on the wrong side of that ledger. They're sitting as the customers just parking their money there. Now, what you said, over time, we realized, that there's better places for our money to be, active in. So instead of just having a savings and checking account, which we still have, of course, we've also extended our places to put our money into these policies. And to your point, why? Why is that different, or why is that better than just kind of sitting there in the bank? Well, through an IBC system, even if it's one policy, your money gets to do many multiple things at the same time.
So when people hear what you just said about storing money in policies, what part of that idea do they usually struggle with the most?
Okay. Well, I mean, it's that idea that, hey, your dollars can actually do more than one thing at a time. I mean, me as a man, right? Tunnel vision, I'm a goldfish. You give me one task and they'll be lucky if I can finish that. But I can't multitask, right? Same thing with our dollars. If it's just sitting as cash in a savings account, it can only do one thing at a time. Earn that, paltry interest, taxable, by the way, right? For whatever amount that you leave in there. So it kind of tends to be illiquid as well as earning a low percentage of interest. But that's the one track that it gets to run on while it's there, right? As opposed to in an IBC policy, you have all kinds of things going on. With that first premium payment, you have a death benefit that many, many times exceeds whatever you paid into it for the worst case event when we pass early, right? That's great. That's the life insurance. That's the legacy component. Then you have the cash value, which is that equity in the policy that you can use as essentially a line of credit that, again, you get to borrow other people's money in order to do whatever you want or need to do to buy things, pay for bills, put in investments, or pay for tuition, all that kind of thing. So you have access to a separate pool of capital that's increasing over time. So there's use and liquidity. There's compounding in that death benefit. Long term, it's growing. Short term, it's available. You can do many things with it. So
So I actually have the privilege of sometimes sitting in on calls when you're teaching people about this concept, and I hear this from you often. How do you compare IBC to cash? Because we hear that a lot, right? I want you
yeah,
to
yeah.
share with the audience what you always say.
Well, one thing I say, right, and everyone's heard this one, cash is king. Okay, that sounds cool and that's great. And it's good to be king, as they say, but it's also the flip side of the same coin. I always say cash is one and done. One and done. It can only do, like I said, one thing at a time, at the savings account, or under your mattress. It can only be in one place at one time and benefit you in that way. Now with a policy, right, it's like you enter a third or fifth dimension, right? When you enter that dollar into the policy, now it's going to work in many different ways, like I just mentioned, and is still easily accessible to you should you need it in a pinch or for some opportunity that comes your way. But all the while, until that happens, or even if that happens, it's growing and compounding for you.
So now that you're working, we transition from us just being W-2 or workers, traditional workers, to investors. And now you have transitioned to now actually coaching and working with a lot of investors across the whole country, pretty much. What stands out most to you about what they think about money and how are they thinking about money differently?
Yeah, I mean, again, right? We talked about the last time, how the typical basic question is, what account should I have my money sitting in so that it can do that one job and maybe you eke out 1% more than the other people. Well, the more sophisticated, experienced investors kind of turn the question around, and instead of trying to solve for that one thing, they think about, well, what are the different things that my money can be doing? And ideally, maybe multiple things at the same time, right? And that would involve, different investment opportunities or, different systems of investing, like the income stacking way is built upon.
Yeah, and we'll touch on that. Maybe if not today, but throughout the
Yeah.
conversation that we're going to have. But looking back at your journey or our journey so far, what changed for you when you started thinking in terms of capital flow instead of just investments?
Right. So, I mean, again, investments is a very broad word, right? When you think about it, an investment, even if it's into a CD or something that has a fixed income, a security there that, um, is a regular, tried and true kind of profit potential, to stock market, right? Or even going to the casino, right? I mean, that's going to be a much less secure type of, investment where the profit could be a lot higher, could also be negative or less. So there's that question of what type of investment, right, that you can put your money towards. And again, if you're just investing with cash, it's a one and done deal. You got to wait for that investment, hopefully to pan out and come back with some friends, as far as interest with the principal. Or you can build, and have a system where instead of searching for all these, hit or miss opportunities one at a time, you have a system where you incrementally and intentionally start building these stacks, right? Of even low yielding notes or investments that on a regular basis that you have already a plan of building up to can consistently outpace and outperform the other investments that you're just kind of winging the fence for the fences with.
So it sounds like you're talking about how investors, at least the ones who are a little bit more sophisticated, experienced, they realize that they need to, instead of just chasing after individual investments kind of all over the place, they need to focus and build a system where
Right.
their capital stays active and keep moving in a structured way that almost guarantees, it's almost like having a playbook,
Yeah.
right? And so that guarantees success is it's almost like it's not 100% guaranteed, but you've done it repeatedly enough that you know that the next place is going to be a win. So let's share, what does that ultimately allow them to do, right? That most kind of beginner or inexperienced investors just can't.
Well, again, it goes back to that analogy of, if you're chasing yield, as you kind of mentioned, you're looking for those, home runs or grand slams, and you're stepping up to the plate, use all your force and swing for it, and oftentimes you'll strike out. Okay. Think of the other way to play the game, where you're just hitting bunts, you're hitting base hits, nothing big. You just get to the base, get around, the home plate, get the easy, win. Over time, that's gonna win, because you're not as likely to strike out. In the same vein, if you have a system that works, you don't need a high yield. You don't need these crazy risks. You just build upon that same, track and continue compounding it on a faster and more, consistent basis.
I want to circle back to that analogy that you mentioned about the home base
Sure.
and circle back to the IBC system that we have built because I want you to touch on the the how the this may be getting a little bit technical, but I really like the analogy when you use that the monopoly or the
Sure.
little revolving door. Can you give a little
Yes.
explanation on how that works about
Yes.
that revolving piece? I think that's super important.
So I have, two, you're talking about that Monopoly. We'll start with that. Going around the game board with Monopoly. Remember, when you pass go, what do you get? 200 smackaroos,
200.
right?
Yeah.
$200, right? $200. Every time you go around the board, no matter what, as long as you cross, go, you pass go, you get $200. Well, that's akin to having your annual premium anniversary, your policy anniversary. Every time you round the board, that's 12 more months that have gone by. That's another premium you get to deposit into your system. And that's another dividend payment that they credit to you that'll buy you that sweet PUA and death benefit on an increasing basis. And each year, that dividend is set to be bigger and bigger, right? So that multiple of that death benefit and that cash value growth is growing, not the same rate every year, even if it's the same rate, because of its compounding, it's going to be on a net positive, greater growth every single year. So every anniversary you have, you get a better and better present, right? The other example I use is that turnstile I think you're talking about, right? That New York
Mhm.
City, subway, you go through, you walk in at 3 miles per hour because there's friction, right? It'll slow you down intentionally. It'll slow you down to maybe 1 mile per hour when you walk through. Well, that's your policy in the beginning. In the beginning years, those dollars go in. There's going to be a fixed administrative cost, right? There's commission. There's also, management and the death benefit. But each year, guess what? It gets, looser and looser, right? The friction dies down. And essentially by the over the 4 years, that friction disappears. So when you go in at 3 miles per hour, your dollars by year 4 or 5, certainly 6, hey, that goes in at 3 miles per hour, but because you've already greased the system, you've capitalized it, it's got that compounding going, the turnstile is actually moving on its own. And it's no longer not just slowing you down, but actually speeding you up on the exit. So now you're coming out at 4 miles per hour. All those dollars in are going to be amplified from that point on and on a better and better basis each and every year. Yeah.
And for our listeners who are confused or saying, what is he talking about? You have to read this book because what Mike described is it's all just gems and wisdoms that we have
Absolutely.
kind of pulled and
Beg, borrow, and
made it
steal.
our own,
Absolutely.
right? Out of all these years of reading and rereading these books. Nelson's book talks about the infinite banking system, which is one one of the systems that we built, right? So when you step back and you look at all this, how would someone really think about their capital, right? If they want to have it work for them long term, this is something that you specialize in. You're not just, yes, Nelson's principle is long-term thinking, but the way that we invest and the way that our investment group invest, we actually get to do both. Can you talk about that a little bit?
Well, I mean, if you're talking about getting the best of both worlds, or, I mean, are you talking about the long-term benefit of, the policies, and growing that capital as an asset that appreciates over time? Right. That is absolutely, a common tenet or benefit of an IBC policy. That death benefit grows every year. That legacy that you'll pass on to the next generation obviously is going to be substantial over time. But what people kind of don't understand is that the same very policy can also be re-engineered or repurposed in a sense through the income stacking to provide you that short-term passive income and a regular basis. So you don't have to sacrifice that security and accumulation of that asset for the short-term gain that you can build over time on a regular, consistent basis. You can do both when it's done right.
And not knowing these systems or not knowing how to integrate these systems can cost people a lot of.
That's EVA, economic value added, or simply put, opportunity cost, right? They always say what you don't know can hurt you, right? And that's exactly right. I mean, you won't feel it, right? Because you don't know what you're missing. But believe me, like Nelson says, you can only compare yourself with those around you. And if you can do better than them, you're going to be winning. It's that simple.
Right. And I think maybe the next episode we can dig deep a little bit more about EVA because that actually was one of the concepts in Nelson's book that took me, I would say, the longest to understand. I hear about it, you know, it's spoken about very often, but because it's kind of technical. It sounds simple, but it's what is it? It sounds simple, but it's not easy. So I think that is one topic that we might want to, or at least, I would like to discuss a little bit more, maybe the next episode. But I think ultimately we want to share with people that our money has a cost out there, whether we know it or not out there. So what you and I specialize in with teaching people how to integrate these two systems, the income stacking and the IBC systems, is just to increase efficiency of our capital. And that's what it's all about. And you are so great at doing that with all the people that you coach. And I get to kind of take a peek sometimes.
No, I mean, we are blessed collectively to get to, meet all these folks that, that we come across and learn from them just as well. I mean, we have our system that we, coach and train on, but believe me, everybody's got their own situation and nuances to their capital flow and things that come up in life that allow us to challenge, the concept and really kind of make it better each and every time. So
And before we go, if you can touch on a little bit of the differences between the traditional investors and then the investors that you work with, how are they a little bit different?
like the mindsets and the focus,
Right. Yeah.
sure. Yeah, I mean, I think traditional investing is couched upon, what I call the accumulation mindset, right? And I talk about it in my book, Dibs, shameless plug, right? About accumulation, right? That nest egg idea where,
Did I do that? There, here's the book.
yeah, you save 10 or 15% of your money every month each year, and you try to build up to that nest egg of whatever the mythical used to be $1 million. Now it's like $2.5 million of a nest egg that you'll need to, for retirement. And that's a lofty goal. And for a lot of folks, a lot of Americans today, they're realizing even doing it the right way as they were told all these years, it's not going to happen because life gets in the way and there's always going to be interruption to that compounding. The other way, which I find to be much more powerful and effective, and a lot of what we, teach with our investors to do is focused on that cash flow method, right? The incremental, the regular, hitting those base runs, on a consistent basis. And it's like that joke of, how do you eat an elephant, right?
one bite
What?
at a time.
That's it. It's a bad dad joke, and I'm a dad, so there it is. And it's the same thing with our money. It's a lot tougher to kind of imagine this big white elephant, over so many years. But it's a lot easier to focus on what can I do on a monthly basis. Now
Mm,
we're not talking $2 million, but maybe it's $300 a month that I can kind of build out on a passive income basis each month. Maybe over the course of a year, I can build up to $800 or $1,200 a year. And then soon enough, over time, a short time, with this system, you can build yourself an equivalent of whatever that 1.5 or $2 million nest egg would otherwise need to provide you. So
yeah.
it's just breaking it down on a much more palatable and digestible basis of, that cash flow model or thinking.
Yeah. And we ultimately we're still accumulating. We're just
Oh yeah, you
accumulating
can't
a
help
little
it.
bit differently. That's right.
That's right. It's just like the policy, right? All the while that policy is building in cash value and death benefit and growing each year better and better. The whole death benefit over year as that legacy onto the next generation. You can't stop it. Like Nelson said, once you solve for that need for financing through the available cash values that are in your policy, even one policy, you can't help but have a nest egg, at the end of the story that's going to way exceed any investment, without all that risk. Mhm.
Yeah. We can just go on and on forever.
Right. No.
I think the most important thing, the message that I want to get out there today is that whether you're already a sophisticated, experienced investor, or if you're someone who, have been investing traditional way for a long time, but now are interested or intrigued about cash flow in investing, that's where we specialize in. Or if you're someone who's never even invested, but just starting to learn about investing, we have strategies for the whole entire gamut, right? But as long as you're looking for ways to enhance your policy system or your investment system, this is where this is our wheelhouse. This is what we love to do,
Yeah,
right?
make sure you have a safe home for your money, right? As you get ready and learn up, the different ways that you can deploy it, have that foundation built through the policy or, and that's what we're talking about for now, because trust me, you can do all kinds of things. It's just limited to your imagination, like Nelson said. Um,
That's the infinite
that's
in
the
the infinite
infinite in
banking.
infinite banking. Yep,
Yeah,
yep.
perfect.
So
Thank you so much.
well, that sounds good. We all hope that you've enjoyed today's conversation. And I, as an IBC coach, income stacker, and fellow investor, will continue to dive deeper into these topics and share our knowledge and experience in future episodes. So if you find these topics interesting, be sure to like, subscribe, and comment, and share with someone who might also be interested in building passive income in a safe manner with us. Until next time, thanks for being here, Pei.
Thank you.
Signing out.